Have you ever wondered what causes a stock market crash? These sudden and severe declines in stock prices often lead to significant financial losses and can leave even the most seasoned investors scratching their heads. But what if I told you that these crashes, while unpredictable, are not entirely without warning signs? Yes, there are indicators that, if closely monitored, can help you mitigate the impact of these financial tempests. Imagine a stock market crash as a thunderstorm. It's unpredictable and it can be devastating, but just as meteorologists can forecast a storm by observing changes in atmospheric pressure, investors can predict a potential market crash by recognizing certain economic and financial patterns. So what are these warning signs? They range from market overvaluation, where stock prices significantly exceed their intrinsic values, to excessive optimism, where the widespread belief that markets will continue to rise indefinitely can lead to reckless investment behaviors. Rising interest rates, geopolitical tensions, high corporate debt levels, an inverted yield curve, and increasing unemployment rates are also significant indicators. For example, consider the year 2025, when Howard Marks noted that the above-average S&P 500 valuations and the heightened enthusiasm around artificial intelligence could be red flags for a potential market crash. Around the same time, tariffs on various imports introduced significant uncertainty among investors, signaling possible market volatility due to geopolitical tensions. These indicators aren't foolproof, and they don't guarantee a crash will happen, but they can provide valuable insights into the state of the market. By staying informed and keeping a close eye on these signals, investors can make strategic decisions to protect their portfolios and potentially soften the blow of a market downturn. Understanding these indicators is like learning a new language. It can be challenging, but it's also incredibly rewarding. The more fluent you become, the more you can navigate the complex world of investing with confidence and foresight. So, are you ready to learn this language and unravel the mystery of stock market crashes? Today we will uncover the key indicators that could signal a looming stock market crash. Firstly, let's talk about market overvaluation and excessive optimism. Market overvaluation is when stock prices significantly exceed their intrinsic values. Think of it like this: if you're buying a house, you generally want to pay a price that reflects its true worth. Now, imagine if houses in your neighborhood suddenly started selling for twice or even thrice their actual value. That's a bubble. And like all bubbles, it's bound to burst at some point. In the world of stocks, this bubble is often caused by investors paying more for a company's stock than its earnings justify. For instance, famed investor Howard Marks noted in January 2025 that above-average S&P 500 valuations and heightened enthusiasm around artificial intelligence could be red flags. If everyone's rushing to buy without considering if the price makes sense, that's a clear sign of overvaluation. But where does this rush come from? Enter excessive optimism. This is the widespread belief that markets will continue to rise indefinitely. It's a bit like seeing everyone around you win a lottery and thinking, well, I'm bound to win next. This kind of optimism can lead to reckless investment behaviors, as people throw caution to the wind and invest without due diligence. Remember, the stock market isn't a lottery. It's a place where companies and investors come together. And companies, like all of us, have good days and bad days. They grow, they stumble, and sometimes they even fall. The belief that stocks will always rise is not just unrealistic, it's dangerous. Excessive optimism can fuel market overvaluation as investors keep buying, driving prices up beyond sustainable levels. And when the bubble of overvaluation bursts, those who were excessively optimistic often find themselves facing significant losses. These two indicators, market overvaluation and excessive optimism, can often create a dangerous cocktail for the market. By recognizing these signs, investors can steer clear of potential pitfalls and make more informed decisions. After all, in the world of investing, knowledge is the best tool for success. Another crucial factor to consider is rising interest rates. Central banks often leverage interest rates as a tool to combat inflation. But how does it work? Simply put, when inflation is high, central banks may hike interest rates to cool down the economy. This makes borrowing more expensive, which can slow down spending and investment. But here's the catch. While this strategy might be effective in controlling inflation, it could potentially slow economic growth. With borrowing becoming a pricier proposition, businesses might reel in their expansion plans. Consumers might shy away from big-ticket purchases, and investors could become more risk-averse. And the stock market, it doesn't respond well to slowing economic growth. Higher interest rates can mean lower corporate profits, which can lead to a decline in stock prices. So, the next time you hear about an interest rate hike, don't just brush it off. Remember, a sudden rise in interest rates can be a red flag. Geopolitical tensions and high corporate debt levels can also significantly impact the markets. Let's dive into the details. Geopolitical events such as trade wars or political instability can send shockwaves across global markets. They create an atmosphere of uncertainty that can cause investors to panic, leading to market volatility. Take the tariffs on various imports introduced in 2025, for example. These changes unsettled investors worldwide, causing a stir in the stock markets. But how does this happen? Well, imagine you're an investor. You've put your money into a company that relies heavily on imported goods. Suddenly, a new tariff is introduced, increasing the cost of those goods. That means the company's expenses go up and its profitability could take a hit. As an investor, you're likely to be concerned about this, and you might even consider selling your shares. If enough investors react this way, the result could be a substantial drop in the company's stock price. Now let's turn our attention to high corporate debt levels. When a company is loaded with debt, it's more vulnerable to economic downturns. If revenues decrease, the company might struggle to meet its debt obligations, potentially leading to defaults. This financial strain is not just bad news for the company, but for its investors too. A company's inability to repay its debt could result in a significant drop in its stock price. To illustrate, consider a hypothetical company we'll call Tech Titan. Tech Titan has been riding high on the tech boom, taking on considerable debt to fund ambitious projects. Everything's fine while the economy is strong, but when the economy takes a downturn, Tech Titan's revenues fall. Suddenly, that mountain of debt isn't so manageable. If Tech Titan defaults on its debt, its stock price could plummet, impacting the portfolios of its investors. So you see, geopolitical tensions and high corporate debt levels can create a climate of uncertainty and volatility in the stock markets. These factors can create a domino effect, leading to a potential crash. Lastly, let's delve into the inverted yield curve and rising unemployment rate. Firstly, the inverted yield curve. This phenomenon occurs when short-term interest rates surpass long-term rates. Now, you might think, why does this matter? Well, an inverted yield curve has a historical precedent of anticipating economic recessions and potential market downturns. It's like a financial fortune teller, hinting at a future where borrowing is cheaper in the long term than in the short term. This could imply that investors are not confident about the near future's economic prospects. So, when you see the yield curve inverting, it might be a sign that storm clouds are gathering on the economic horizon. Now, let's move on to the unemployment rate. A rising unemployment rate can be a clear signal of economic weakness. When more people are out of work, consumer spending tends to decrease, which can lead to a slowdown in economic growth. One rule of thumb to remember here is the Somm rule, named after economist Claudia Somm. This rule is triggered when the 3-month moving average of unemployment rises by 0.5% or more, often preceding recessions. In essence, a spike in unemployment can be the canary in the coal mine, warning us of potential economic trouble ahead. So when you notice an inverted yield curve and a rising unemployment rate, it's like the universe is sending you a message. It's telling you to be cautious, to reassess your investments, and to prepare for possible turbulence ahead. Remember, these are just indicators, not guarantees. They are tools to help you navigate the complex world of investing. They can help you make informed decisions, but they can't predict the future with 100% certainty. These indicators can be the final pieces of the puzzle, signaling a potential market downturn. Understanding these key indicators can help investors prepare for potential market crashes. So let's recap. Market overvaluation is a clear warning sign. When stock prices start to significantly exceed their intrinsic values, it's time to take note. Never underestimate the impact of excessive optimism either. When everyone around you seems to be under the spell of perpetual market rise, caution is warranted. Rising interest rates can signal turbulence ahead, as they make borrowing more expensive, potentially slowing economic growth. Geopolitical tensions and high corporate debt levels can also be triggers for market volatility. The inverted yield curve and rising unemployment rate are two key indicators that have historically preceded economic recessions. By keeping a keen eye on these indicators, investors can make strategic decisions to protect their portfolios. Stay informed, stay prepared, and remember, knowledge is power. Don't forget to comment, like, share, and subscribe for more insights.